Today, we're going to talk about investors, but more importantly, we're going to talk about how passive investors can protect themselves when you're thinking about placing an investment into a private placement offering. So many of you that have invested in the last few years have invested in lots of asset classes, right? Everything from multifamily, self-storage, mobile home parks, maybe land banking, mixed use, maybe medical office, or other types of asset classes in commercial real estate. And you've thought to yourself as you're about to sign the subscription agreement or initiate the wire transfer or hand over the check to the sponsor, operator, syndicator, what can I do or what should I be doing about how to protect yourself? Now, remember, investing is not risk free. There are risks associated with every type of investment. So going into an investment thinking that this is a stone cold lead pipe lock, there's nothing that could ever happen to this investment where it might not result in the fulfillment of the business plan, the plan that you read, the plan that you were going to invest upon, especially in the commercial real estate market where we do go through cycles, right? So we went through a cycle early 2000s, we went through a massive cycle in 2008, and now we're going through another little cycle now, which means every little cycle you have to look back in time to think about what was I thinking at the time that I was investing, right? When you're going to suffer some sort of loss. So here are 5 things that passive investors can do in order to better protect yourself, not make an investment risk free, right? But better protect yourself as you go into an investment. Number one is vet the sponsors. The sponsors are the people that are putting the deal together. Ask them for their track record. Maybe even ask them if you could run a credit check on them. See if they've ever filed for bankruptcy. See if they can tell you what their track record is for owning, operating, or sponsoring similar deals in the past. It's not a complete red flag if they've never done a deal before, but you certainly in a volatile market condition, you want to know that you're investing with operators, sponsors, syndicators, use those terms interchangeably with one another, that know how to navigate the complexities of the market given the particular time that you're investing. Okay, so vet the sponsors and the track record. Number two, read the investment documents and the operating agreement or the limited partnership agreement. Okay. If you're not prepared to read those documents, you should hire an attorney to read those documents for you because those will most often have what risks are actually associated with the transaction. It will have essentially where is the investment, who is going to be the potential lender, what's the size of the investment overall, what are the terms of the investment, what are the rights and obligations associated with the passive investor during the life cycle of the investment. So super, super key for you to read the investment documents and the operating agreement, or hire a professional to have those read to you and have them explain essentially where the pinch points are. Now, not everything that's in an operating agreement or a private placement memorandum is monumentally important, but it's certainly important for you to understand as a passive investor going into an investment essentially what those deal points are. Number three, attend the webinars or the updates. Many sponsors, syndicators, or operators of an investment will have an initial webinar where they're raising capital to describe essentially what their business plan is. But even after that, they will have other updates associated with that. And if you're not attending those webinars or you're not attending or reading the updates, whether they come out on a monthly, weekly, biannually, or annually basis, it's super important for you to stay informed about your investment through the life cycle of that investment. Number four, this is simple, but it's very, very important. And sometimes the most simple things are some of the key factors associated with any investment. And that is ask questions. If you don't understand a term or a part of the business plan, it's okay to ask. Not everybody is expected to have a law degree when you're investing in things, right? So if you don't understand something, more likely than not, you're not alone. More likely than not, somebody else that's potentially looking at this investment is asking the same exact thing. So I was always taught the worst question is the only one that you don't ask. So the reality is, please, please, please ask the sponsors, operators, syndicators questions if you have any questions associated with any term that you do not understand. And then number five, and this is super important. And this is, remember, in investing, there are cycles, right? So I don't care if you're a stocks or bonds investor, if you're a commercial real estate investor, if you invest in crypto, if you invest in pre-IPO tech companies, there is volatility in all of these asset classes, and there are cycles associated with all of those. So you need to be mentally prepared to accept that one of the risks associated with investing might actually ripen. That means that one of the risks that are listed in the private placement memorandum or the prospectus that you read might actually come to fruition. And that means that potentially you might lose some of your capital, or worst case scenario, all of your capital that you invest. So it's very, very important for you not to get over your skis. Do not invest if you cannot afford to lose the money. Now, that might sound counterintuitive because you're like, I only want to invest if I make more money. The reality is, the best mental preparation is for you to be a qualified and suitable investor for the investment, such that if you were to sustain the total loss of your investment, you could still weather that loss and not be significantly harmed. That's a very, very good thing for you to understand and be mentally prepared associated with that. So those are the five kind of ways in which passive investors can help protect their investment. Vet the sponsors and the track record, read the investment documents and the operating agreement, attend the webinars and read the updates, ask questions if you don't know the answers to something, and be mentally prepared associated with your investment. I hope this information was helpful for you. If you're somebody that's out there looking to invest in commercial real estate, Godspeed and happy hunting.